We were a little bit unique in starting the fund in 1987. In order to understand the landscape in 1987, you really have to go back to the beginning of when we started the firm in 1974. There were very few funds around during that period of time. There were only about 150 mutual funds in existence. By 1987, that had grown some. There were less than 500 mutual funds in existence. Less than $50 billion were invested in 1974 in mutual funds. In 1987, approximately $450 billion were invested in mutual funds. So it was somewhat of a little bit of modest growth. Certainly modest in today's marketplace, where there's $17 trillion in mutual funds today. We started with the thought that to preserve wealth in a real sense, you had to buy assets that were growing faster than inflation. Well, how many assets do that? Well, businesses, of course, do that. And so our investment approach was really looking at businesses.
When Tom started the fund in 1987, he had a certain approach, and it's really the approach that we still use today. So we invest in a relatively small group of companies. We normally have fewer than 40 stocks in the fund. They're typically high-quality businesses that are profitable, have good balance sheets, and generating cash. We still do that today. We're very long-term. We have a very long-term holding period. And we continue to think management's a very important part of owning a stock, and we continue to test that by going out and meet with management. A big part of our performance is holding on to stocks that have done well, and when we realize we have a really great company, really well managed, is to hold on. And we've been able to make 5 or 10 or 20 times our money in those type of stocks over a long period of time.
We look for the best-in-class businesses, and that translates to high quality. Fenimore's value investment philosophy considers a risk-conscious approach. In structuring portfolios bottom up with investments that we create from small and mid-sized companies, we're really seeking to achieve a long-term compound that can beat the market and inflation.
The outlook for 2018 is really more of the same. The economy is growing. It actually might be starting to get a little better, growing a little faster. Corporate profits will be a record this year, and we think they'll be a record next year. So I think those trends continue. The new thing, of course, is new tax law. Corporate tax rates are going lower, so earnings will be even higher than we originally expected. American businesses are worth more if they're paying lower taxes. So we have to reassess all of our valuations, but the trends in the economy and the global economy are really the same.
My advice to an investor today is make sure that you are investing in someone who you can trust, and that the way that they invest is understandable to you. And if you feel comfortable with that, then that's probably a good way to look at the investment world.